All right, hello everyone and welcome. My name is Anna and I'm thrilled to be moderating the panel today. I'm going to briefly introduce myself and our panelists and then hand it off to them to present their really excellent and thought-provoking papers. After that, we'll do an audience Q&A. I'm a third-year student at the law school and the co-editor-in-chief of the Yale Journal on Regulation, which focuses on financial regulation, Delaware corporate law, and also administrative law, and within administrative law, environmental law issues. I'm really excited to moderate this panel today. I think these three papers, when you zoom out, are brought together by concerns over the method and substance of regulating sustainability, both what it means and how it can be implemented. Probably everyone in this room can agree that regularized standards are needed to confront the climate crisis. Everyone can probably also agree that greenwashing is rampant in an environment without rigorously imposed standards. If we take as a given that the private sector is not incentivized to create and enforce adequate definitions and measures of sustainability, the question becomes, to what sources do we look to impose standardization, and what would standardization look like? What should be standardized? These papers intervene in this discussion by pointing out what existent debates over standards are missing: attention to Indigenous rights, the potential for divergent standards for public versus private companies, and the limits of disclosure and other existent tools as an effective enforcement mechanism. And they suggest solutions. I'll do some brief introductions and then hand it over to the panel. First up is, without Indigenous rights, it's not sustainable. We have two panelists for that paper. Emil is a management consultant at the Swedish sustainability consultancy Ethos. As a consultant, Emil works on a wide range of topics ranging from helping clients in the financial services sector integrate environmental, social, and governance considerations in investment decision processes and investment advice to implementing human rights due diligence in processes for companies in the real economy sectors. Emil is a Swedish Ecuadorian double national and a member of the Quechua people of Sarayaku, an indigenous community in Ecuador. Moira brings over 20 years of human rights and social justice advocacy, campaigning, and field experience to her work at Amazon Watch to hold the financial industry accountable for its contributions to indigenous rights abuses, Amazon deforestation, and climate change. Prior to Amazon Watch, Moira researched community-based models of alternative economies, advocated for affordable housing, and promoted environmental protection, and spent several years as a human rights observer in Colombia. Moira has a BA in Latin American Studies from the University of Michigan and an MA in International Relations from Tufts University. Jem, presenting on the sustainability arbitrage problem and regulation of private companies, is an assistant professor of commercial law at Koç University Law School in Istanbul and is an affiliated scholar at the UNESCO Chair on Gender Equality and Sustainable Development and the editor-in-chief of the Nassimer Law Blog. He holds an LLB degree from Galatasaray University and a Magister Juris from Oxford. Following his master's studies, he co-authored a book on the economic analysis of leveraged buyouts. Having pursued his doctoral studies in corporate law at Istanbul University, his dissertation entitled Contractual Freedom and Articles of Association and Its Limits in Company Law was published in 2021. He participated in various international projects funded by the European Union, the World Bank, and British Council. His research areas include corporate law, banking and capital markets law, arbitration law, and sustainability and business law. Lastly, but not least, Tom, presenting on green pills, is an associate professor of law and finance at the University of Oxford and the founding director of the Oxford Sustainable Law Program. His research explores how law and finance can address externalities and advance the public good, with a particular focus on climate crisis and systemic risk in financial systems. He actively collaborates with and advises governments, central banks, corporations, NGOs, and international institutions, including the Bank of England, the European Central Bank, the International Monetary Fund, and the United Nations Environment Program. In 2022, he was appointed to a 2-year term as a member of the European Securities and Markets Authority's Consultative Working Group on Sustainable Finance. With that, I will hand it off to our first speaker, who I believe is Emil. Great, thank you.
So before talking about the paper, I'll just give some context to the paper and some background. Throughout the whole world, indigenous people are seeing increased threats towards their rights and territories, which is often related to corporate activities as well as government activities that operate on indigenous lands without prior and informed consent of indigenous peoples. So statistics, we can see, for example, in the Environmental Justice Atlas, indigenous peoples are affected in 40% of all the cases, around 3,000 cases. Attacks against human rights defenders are increasing. Indigenous peoples are 5% of the total population, but are affected in 30% of the cases. And this has historically been in the extractive industry and the agro business as well. And now we can see that it's also increasing in the renewable energy sector. So between 2015 and 2021, I believe, Business and Human Rights Resource Center were 800 attacks against indigenous human rights defenders, out of which 134 were in the renewable sector. And they also look into the policies of the companies in the renewable energy sectors, which, so the result is quite clear. They aren't addressing their human rights intelligence approach adequately, especially not when it comes to indigenous rights. And I think this one problem for investors is that indigenous rights hasn't really been incorporated into many of the frameworks that are relevant in ESG and sustainable finance. So if we look at the reporting frameworks, SASB has a few indicators, GRI has a few indicators. The ESG ratings overall, they might take one indicator into account, but overall it hasn't really been incorporated. Also, if we look at the different initiatives of GFANs, net zero alliances, they rarely mention indigenous rights, but the Insurance Alliance actually has mentioned it. So there is some progress. But also with this said, I will go into more on a personal level because as was mentioned before, I come from Sarayaco in Ecuador, which is an indigenous community. So in 2002, oil companies together with the Ecuadorian government tried to come into our territory, and when we said no, they basically invaded our territories together with Ecuadorian forces as well as private security. But this wasn't one case, it has been going on since 1996, and it has been going on ever since, even after the company left, after we took them to court in the North American Court of Human Rights. And I think what I learned is that investors can have an influence because in 2005, Amazon Watch organized a fact-finding mission to Ecuador, where they, together with Boston Common Asset Management and various asset owners here in the US, they went to Ecuador, where I come from, so that they could see with their own eyes that when the companies were saying that, yeah, we have the consent of, we have 80% support for our project, but that was a lie. So when they went to see with their own eyes, then they could see that it wasn't actually the case. But I remember even as a kid, I could see they tried to create division in the communities, and they created like rumors. But of course, this wasn't being reflected into what was being presented for the investors. So the investors would see graphs where they said 90% of the community supports this project. And that was 20 years ago. But still, since then, it hasn't really been incorporated into most of the frameworks. So I think I think if you look at the contents in this symposium, there's a lot of focus on environmental issues. But and that's also why it's not adequately reflected in the different frameworks, I believe, because it's not being addressed. So I think that's one area where we need to focus more. And now Moira will talk more about the paper.
Thanks, Emil. So as Emil just named, our sense and our own experience, both as community members in Emil's case and as practitioners in both of our cases, had been that the sustainable finance world was paying scant attention to indigenous rights. So in this paper, we sought to understand the extent to which this is true and how much this matters both to the credibility and the financial sustainability of the sustainable finance industry. So we evaluated corporate responsibility guidelines, sustainability reporting standards, ESG ratings, and also some investor sustainability policies and best practices. And we indeed found that the current landscape largely fails to provide investors with an understanding of the interaction between corporate activities and indigenous peoples and their rights. Today, in this talk, we want to focus on these questions about the credibility of the sustainable finance industry and also its ability to properly mitigate financial risks as it relates to this lack of attention to indigenous rights. And we're focusing on that because I do hope we can all agree that respect for indigenous peoples and their rights does matter on moral and ethical grounds. So why is this lack of attention to indigenous rights a credibility issue for the sustainable finance world? First, and this is not going to be shocking, I think, if an investor is making claims about sustainability, about climate action, about human rights, then those claims should be backed up with action. We argue that a key place for credibility on that is indigenous rights for two main reasons. One is the body of international law, and in many countries, national law, protecting indigenous rights. And because of indigenous peoples' crucial role in climate change and biodiversity loss mitigation. A few words on the international law piece. In addition to enjoying the human rights that everyone enjoys, the Declaration on the Rights of Indigenous Peoples, which was adopted by the UN in 2007, enumerates additional rights for indigenous peoples. And it's important to note that the Declaration has been adopted by basically every UN member state and as such is considered customary international law. And I will not get into the many articles of the Declaration here, but it's important to note that the underlying right in the Declaration and other international and national legal frameworks around indigenous rights is self-determination, right? Which necessarily encompasses indigenous people's right to make decisions about projects affecting them and their territories. And on the climate change and biodiversity loss mitigation piece, right, the IPCC and many other scientific bodies have made clear that preservation of old-growth forests and other biodiverse ecosystems is essential to achieving Paris Agreement goals. And studies regularly show that the most biodiverse and best conserved ecosystems on the planet are the ancestral and tidal lands stewarded by indigenous peoples. In other words, indigenous peoples are key players in climate stability and biodiversity protection. But why do we argue that attention to indigenous rights is also a financial sustainability issue? Well, according to our own research as well as that of colleagues, investors, and of course it's investors of all types, face financial risk from inadequate corporate regard for indigenous rights and the conflicts that often arise as a result of that disregard. So conflicts like this tend to happen when companies fail to adequately consult with communities who are impacted by proposed projects and or when they approach consultation as a box to check rather than a process to seek consent from impacted populations and make adjustments accordingly. So as such, we argue in our paper, and we and others have also argued elsewhere, that disrespect for indigenous peoples and their rights, particularly on this issue of consultation and consent, generates legal, political, reputational, and operational risks for companies and investors. So just to give one brief example, the South America-based oil company GeoPark lost at least $70.8 million per a review of its SEC filings from its failed attempt to start drilling operations in an oil block overlapping with the territory of Achuar and Wampis peoples in the Peruvian Amazon. So the Achuar and Wampis had made extremely clear publicly and very clearly that as soon as GeoPark announced its intentions to drill in this block, that they would block GeoPark's plans, and they in fact did so, and GeoPark declared force majeure and left a few years later. And as Emil already mentioned, it can be tempting, particularly for the sustainable finance world, to assume that the clean energy transition will avoid indigenous rights abuses that we often see in the extractive sector. However, and as Emil noted, the accelerated demand for renewable energy is not immune to this risk. And that's largely because indigenous and tribal peoples are often at the front lines of mine sites, both here in the US and abroad. Because of all this, we argue in our paper that mainstreaming Indigenous rights is central to a sustainable finance, and we suggest 3 changes to ensure that investors are adequately addressing the Indigenous rights gap and the risks it can generate. So first, as ESG and sustainable finance initiatives develop standards and frameworks, for example, the Task Force on Nature-Related Financial Disclosures, such standards must incorporate Indigenous rights. Second, investors themselves should adopt policies that commit to respect Indigenous rights, including both ceasing and mitigating harms to which they're directly linked through financing relationships. Third, and I'll add a little more detail on this piece since regulation is the focus of this panel, we think financial regulators must incorporate respect for Indigenous rights and analysis of the risks of disrespect for those rights into supervisory and regulatory frameworks. So we are starting to see a bit of this. As an example, the European Commission's sustainability reporting standards, which are currently under development, would require, under the current draft, that companies disclose the extent of alignment of their policies with standards like the UN Declaration on the Rights of Indigenous Peoples, which is great. And while reporting requirements are crucial tools for evaluation and risk assessment, they do not actually ensure that firms are incorporating that information into decision-making processes. And so we argue that corporate action and further regulation is needed to ensure actual risk mitigation. Just to close on this note, the consequences of inaction will be both local and global. As the 2022 IPCC Climate Change Mitigation Report notes, if current trends of deforestation and land grabbing continue in places like the Amazon, crucial ecosystems like that rainforest, quote, may reach an irreversible tipping point beyond which it will be impossible to remediate lost ecosystems and restore carbon sinks and Indigenous peoples' knowledge. Thank you.
Thank you, Anna. Good afternoon. My name is Cem. I'm working as an assistant professor of corporate law at Koç University, Istanbul. I'll present our paper entitled The Sustainability Arbitrage Problem and Regulation of Private Companies, co-authored with Abdurrahman Kayıklık. After a brief introduction, I will explain why private companies are critical to attaining sustainability goals and how a single-minded focus on listed companies could create a loophole within the regulatory framework, paving the way for sustainability arbitrage. Then I will explain the current sustainability-oriented approaches developed in corporate and securities law and discuss their effectiveness or ineffectiveness in terms of private companies. And finally, I'll focus on 2 possible strategies in response to the sustainability arbitrage problem. In the face of climate crisis, there's a wide range of policies in company law and securities law, but these approaches all focus on listed companies or public companies. In the meantime, as a matter of terminology, I will refer to only companies listed on a stock exchange as public companies. So private companies are subject to generic regulatory tools such as carbon pricing and environmental regulation, but public companies they are also subject to increased pressure from regulatory and regulators and investors. So these are sustainability disclosures and corporate sustainability due diligence rules. So private companies are put in an advantageous position, and in which, in turn, this undermines the effectiveness of the regulatory policies in place. So at this point, the sustainability arbitrage problem steps in. By this term, we mean private companies having an advantage vis-à-vis their public rivals in terms of engaging in unsustainable operations, which we expect to gradually result in an increased share of private firms in carbon-intensive activities. Consequently, there is a serious risk that we end up in a world where public companies look much greener and cleaner, yet the planet is not better off. So I won't dwell on the details about general significant share in the economy overall of private companies, but when it comes to their significant share in greenhouse gas emissions, according to CDP, 71% of industrial emissions in the last 3 decades could be associated with 100 fossil fuel producers, and when state-owned entities are excluded, almost 25% of the carbon majors' so-called legacy emissions comes from private firms. And according to International Energy Agency, 7 public oil majors only account for 10% of estimated emissions from industry operations, with the rest belonging to the state-owned and private companies. And we observe a growing trend of emissions on private sides. So, at the end of the day, private companies, especially those in the carbon-intensive sectors, should be in consideration in climate-related policy making in any case. So let's see different types of manifestations of sustainability arbitrage. First, public firms may choose to cease some of their carbon-intensive activities to avoid investor backlash, whereas private firms can still invest in building new capacity. For instance, a private firm may obtain new licenses and build facilities for fossil fuel exploration, while a public company shies away from doing so. Indeed, there is evidence this scenario is already playing out in the American oil industry. According to Financial Times, privately held producers, often smaller companies, will account for more than half of the total U.S. output growth next year, compared with about 20% in a typical year. When we look at the other side of the picture, SEC-registered firms under obligation to disclose mine safety information were more likely to close their most dangerous mines than non-disclosing firms. So, while a private company may engage in activities with high emissions from scratch, the more likely scenario, and the most obvious one, is shift of dirty assets or brown assets from public to private entities. So this phenomenon is also called brown spinning, transferred emissions problem, or climate-driven asset partitioning. My colleague Tom and his co-authors have also pointed out this problem in their excellent blog at the Oxford blog. So a classic and striking example is BP's sale of its Alaska oil fields. I will just skip the other examples, but at the end of the day, public companies can manage to reduce their emissions and look cleaner, yet the same activity is resumed by a private company out of sight, out of mind. So this is because private firms are typically much less transparent about their emissions. Again, this is the third manifestation of sustainability arbitrage. There are different channels of this. So uneven regulatory playing field can accelerate the current trend towards privatization or staying in private. So I might just enumerate delisting or abstaining from going public, or shifting in investments to private funds rather than public markets. So in this section, we examine the current scholarly and regulatory approaches to corporate governance within the context of climate change, and explain why they are not likely to prove effective in preventing sustainability arbitrage. Since private companies lack most of the sustainability-focused corporate governance mechanisms available in listed companies, scholarly or legislative efforts and market practices focus on integrating climate-related considerations into the decision-making processes. So here we can distinguish these strategies into two according to the actor which is focused on. On the one hand side, we have approaches focusing on the board behavior. So these are trying to provide broader discretionary power and or necessary incentives to do this. We can give an example, redefining of directors' duties, tying executive pay to ESG-related goals, or integrating independent directors into the board. On the other hand side, we have investment stewardship, in which we are trying to enable and facilitate investors' pressure on companies. I won't explain all these strategies, but all in all, one should not make much account about these strategies within the context of private companies, because directors' interests are typically aligned with those of the controlling shareholders, and on top of that, appointment and removal rights are likely to be more straightforward disciplinary mechanisms in private companies. So I'll just skip these slides to gain more time. But I have to say some additional reasons about investment stewardship. So when it comes to private companies, they rely on debt financing rather than equity. So it leaves them isolated from large institutional investors in most cases. Any such pressure would have little chance of success in the presence of a controller. So for us, a meaningful change in private companies in relation to environmental issues will require pressure originating from other stakeholders than shareholders or investors. So here comes possible strategies to counter sustainability arbitrage. Our paper is concentrating on addressing this specific problem. I have to say that these are, extending climate-related disclosure to private companies and responsible divestment and phasing out strategies. So these are complementary mechanisms targeting different aspects of the problem. And they have all own strengths and shortcomings. So they are not competing with each other. So, but what should think of this? We should think of this fundamental question. So, do we need a mandatory regulation? So, this question should be thought only in terms of extension of climate disclosure, as it would require government regulation. We think yes. First of all, voluntary compliance may not always be optimal. So, even if there is a business case, which means that the firm would not benefit from sustainability arbitrage, the controller may still not to follow this path. And second, there is no market for corporate control for private companies. And in the face of climate action failure, potential failure, this disclosure requirement should not be left to private ordering. So the numbers are in parallel with this view, actually. So 85% of public companies reporting to CDP, which had gone private by 2021, ceased reporting to CDP. And mandatory set of disclosures rules would contribute to comparability, consistency, and completeness of the information provided. So whereas standardized voluntary disclosure may allow selective release of data, hence a greater opacity about the externalities private companies impose on the climate. So, since sustainability arbitrage allows private companies to start, overtake, and expand dirty operations without the publicity and the investor pressure resulting therefrom, the first strategy that could be employed is mandating certain private companies to disclose. So, here is a recommendation as an exemplary disclosure framework for private companies. First of all, private companies operating in the relevant jurisdiction has to disclose their emissions, and the disclosure of emissions would ideally be supplemented by an explanation by the company as to what extent its activities are compatible with net zero goals of the relevant country or regional bloc, such as the EU, or the framework set by the Paris Agreement in the alternative. So, disclosure of these two elements would have two functions. It would both reveal the private company's impact on the climate crisis and their compliance level with macro-level net zero goals. And what about financial materiality? So, while private companies can also be required to disclose climate-related risks they may be subject to, that would be a measure and aimed more towards investor protection than sustainability arbitrage. So, therefore, the need for the inclusion of this type of disclosure seems limited in this context, in the context of private companies. We think that this information should be filed within the relevant government authority and should be incorporated in the company's annual report. On top of that, it should be made publicly available via an open access database. We see an example in Singapore, for example. While disclosure, we already are observing a growing trend of mandating climate-related disclosures, but they are principally applied in listed firms. So the prime example is NFRD. So private companies are free from disclosures as well as the public investors' pressure. While disclosure requirements can be extended into private sphere, however, public shareholder influence cannot. So this may prompt the following question. Without the climate-sensitive public shareholders, what is the point of forcing private companies to disclose their emissions? But there are two reasons. First, there are other actors who can exert pressure on private companies, and emission disclosure by private companies can have a larger policy impact by ensuring that policymakers are not deprived of critical information to plan for and effectively manage the transition to a greener economy. So I won't talk about all these different actors. There are lots of recent examples. So in order to minimize costs of this mandated disclosure, we think that financial materiality rationale is much less compelling in this context, so we don't need such information to be disclosed. And only private firms with the largest contribution to the climate change should be subject to obligations, which means that the scope should be based on an emission threshold rather than financial metrics, which may not necessarily reflect the firm's contribution to the climate change. And we also recommend a lower threshold for certain sectors, yet excluding smaller firms from the scope of such requirements comes with a drawback of its own. So carbon-intensive sectors, activity could be split into multiple smaller firms while the aggregate emissions do not decline in the desired amount. So we also propose a lower threshold for carbon-intensive sectors. So my last point would be responsible divestments and phasing out strategy. So some scholars have suggested that institutional investors should use their voice to ensure that these assets and operations are either phased out or transferred only to buyers with similar or equivalent sustainability commitments. So we have to make a distinction between the divestments here. Divestments by institutional investors and by companies owning dirty assets. So the former means an asset manager excluding firms from its portfolio. The latter, however, is about the investee firms divesting from so-called dirty assets. So the alternative is not to sell, but phase them out, of course. The ultimate aim of these strategies is to prevent transfer of dirty assets to less climate-conscious owners. There are two advantages and two disadvantages of these strategies. First, of course, it may block one channel of sustainability arbitrage, especially government-controlled entities' growing share in carbon-intensive sectors. And we need no regulatory action for this kind of strategies, so no compliance costs. But it only targets one aspect of the sustainability arbitrage, so it doesn't solve the taking private issue or expanding the already established factories. So another one is the conditions attached will naturally decrease its sales price, and it may cause some legality problems on the directors or fund managers. So thank you very much.
Okay. Thank you so much to my fellow panelists for really fascinating contributions, and thank you all for being here, and in particular to the organizers for bringing us together here today. So the paper I'm presenting is about the credibility of the commitments that corporations make to reduce their emissions. And I want to start, and by the way, it's joint work with John Armour and Luca Enriquez, who are also at Oxford University. So I want to start by talking about why these climate commitments by corporations matter so much. And interestingly, for a regulation panel, the reason these commitments matter is because there is no regulation by and large, and so we depend on companies making these commitments voluntarily. So this is a generic statement which is always risky to make when you're in a legal audience or when you're a lawyer as well. But roughly speaking, there is no explicit requirement that a private entity, so a company, commits to net zero emissions. That's true for most sectors, for most jurisdictions, and so far. I'm saying so far because this is about to change, particularly in the European Union, where under the new Corporate Sustainability Due Diligence Directive, companies do have to make a plan for the transition to net zero emissions, but by and large, such a requirement doesn't exist yet. So this is subject to some disclaimers. So if you're, for example, an automobile manufacturer and you operate in California or in the European Union, then the cars that you sell will have quite stringent emission standards attached to them. If you have a portfolio that is very risky from a climate risk perspective, then certain requirements attached to that. And then there are a bunch of open norms, tort law norms, for example, in the Netherlands, that have been interpreted to imply a cause of action against companies that do not go to net zero, as we've seen in a judgment against Royal Dutch Shell. But this is pretty much it. Okay? So then there's a final category here, which is, we think, quite an important one, which is a company's own net zero and climate commitment. So once a company decides we voluntarily commit to reduce our emissions, that may lead to some legal obligations. And so, interestingly enough, we have seen some companies commit to go to net zero. Even some of the oil majors have done so. And this is an example from a commitment published by Shell, which is one of the largest oil companies in the world. And they claimed that they're going to go to net zero emissions by 2050, albeit only for scope 1 and scope 2 emissions. Now, when we see statements like this, and there have been many statements like this, also from the financial industry under the Global Financial Alliance for Net Zero umbrella, and other non-financial companies under the UNFCCC Race to Zero umbrella, then we may have felt some skepticism come up. And this is skepticism that is shared by those who model whether globally we are on a pathway to hitting the targets of the Paris Agreement, who point out that if we implement all the goals, all the targets and all the plans that we've claimed to have committed to, then we may get close to hitting the targets of the Paris Agreement. It's not quite there yet, but we're getting close. However, what they identify is an implementation gap where companies and other actors do not act in the way that they claim they will act. And it's that implementation gap where parties, and in this case companies, make a commitment but do not follow through that we are focused on in this paper. And just to illustrate why that skepticism is so relevant, I want to take you to another part of Shell's statement, which is a part where they said, well, wait a second, we may have a net zero plan and a net zero commitment in place, but as of today, Shell's operating plans and budgets do not reflect these newly announced ambitions. So they're explicitly caveating everything, and they're also saying, by the way, these are ambitions, they're part of our forward-looking statements, so there is no securities law liability that should attach to this. We're protected by our safe harbor. So voluntary commitments matter, and they're made at a grand scale, but they may be lulling us into a false sense of security. Now, that brings us to the point of green pill. So what we are talking about in this paper is essentially a way of, I wouldn't quite say fixing this, but providing clarity to the markets about where companies stand. And we're making 3 points that I'm going to make in this presentation as well. The first is that there's actually demand for credible corporate climate commitments from investors. Then second, I'll explain very briefly in this presentation, but at more length in the paper, why current commitment mechanisms are not in fact credible. And then thirdly, we propose a new type of commitment mechanism, which we call green pills, which can generate that kind of credible commitment that we're seeking. So let's start with the demand from investors for these commitments. And we're focusing on investor demand because corporate law, by and large, in most jurisdictions, focuses on the interests of investors. So we think that's the right constituency to talk about. Now, what we do in the paper is we distinguish between different categories of investors. So you can focus on investors that are principally, described by what we call traditional shareholder value objectives. So they care about essentially maximizing the financial value of a particular company or of a portfolio that they hold. And so what they do is they maximize on the stock price and the portfolio valuations. They trade off long-term versus short-term costs and benefits. And we find that in the context of climate change, there are very clear costs and benefits that you can then start to trade off. Climate risk is real, transition risk is real, transition opportunity is also real. And we've seen quite some empirical evidence to that effect presented today. And one empirical study that we refer to in the paper a lot is a study by Bolton and Kasperczyk in 2020, who showed that these kinds of considerations are in fact priced by the market. So if you're a traditional shareholder value investor, you do care about climate change to some degree. In other words, you care to the degree that you think these costs and benefits are going to be reflected in the stock price. However, we are concerned that these investors are not going to push companies far enough. Why not? Well, first of all, because climate policy is uncertain and volatile. So in some contexts, in some countries, it may seem to make a lot of sense to invest in transition and to commit to transition. But then, a certain person becomes the president of the United States, ditches, all these policies and starts waving plaques that say we bring back coal to the US, and suddenly for these climate indifferent investors, the investment proposition may not look so good anymore. There are various other reasons around policy feedback effects that come from lobbying, around heterogeneous expectations amongst investors regarding the costs and benefits of climate change. And by and large, we just conclude that yes, there are some reasons why these types of investors should care, but these reasons are not quite strong enough to get us to the point where, as a society, we should try and get to. So you're going to see some climate commitments, but it's going to be relatively modest. But then we think that this creates a space for other types of investors with different preferences or with different views to step in. And I don't have time to unpack this in great detail, but I will give you the high-level sort of breakdown that we present in the paper. We think there are some investors who have a more, if you will, bullish view on the climate costs and benefits that can materialize, so they attach greater value to mitigating the costs and maximizing the opportunities of the climate transition, so they're stronger, more aggressive in their climate orientation. Then there are some classes of investors which we could term universal owners or systemic steward, as Jeff Gordon at Columbia Law School has done. These are investors who care about negative externalities within their portfolio, and because they hold a very large portfolio, they internalize through the valuations of these companies quite a bit of the impacts, the negative impacts of climate risk, and so they may also be thought to care more than other investors about climate change. And then finally, there are some investors who just have very strong green non-financial preferences, who just really care strongly about the ethics associated with the way in which their money is invested, and who may, from that perspective, care a lot about the commitments that companies make. So we call these three groups of investors climate-conscious investors, to differentiate them from the climate-indifferent investors who purely chase financial gain in the abstract, in a vacuum. And we think that these three groups of investors may push some companies to go further on their climate commitments than would otherwise be the case. Now, still, there are some challenges here, because if you're a corporate manager, you may see these three groups of investors alongside the traditional shareholder value investors, and you may say, well, maybe I can capture some of these investors and benefit from a boost by just engaging in greenwashing, by pretending we do just about enough that we can capture these investors, but not actually engaging in transition too much either, because that's, in their view, might be costly. So we see a lot of greenwashing. We see still the transition cost and policy fluctuations. We see still the problems around heterogeneous investor preferences and beliefs. And we see that the shareholder registry is quite variable. So, and on the one, at one point in time, you may be targeted by an engine number one kind of hedge fund that is pushing for climate-friendly change. But then a bit later, you may be targeted by Strive Capital, who is investing with the investment pitch to reverse all the good work that has been done on the climate front, because they think it's value destructive. So the shifting sense of shareholder preference, in other words, become quite problematic for this corporate commitment, which is why we might see some intertemporal instability of the firm's climate strategy, which is a fancy way of saying firms do not keep their climate commitments. Now, we think that rational green investors and rational climate-conscious investors will discount companies' commitments if they think they're not credible, which means that we should focus on the credibility of these commitments. Now, what's a credible commitment? What should it do? Roughly speaking, we think a credible commitment ties the firm's hands when it comes to climate pledges. So if you promise to reduce your emissions to net zero by 2050, then you have to do that. And if you don't do it, there's some consequence attached to not meeting that pledge. So it cannot be, the pledge cannot be unwound without significant costs. And that removes the carbon commitment from vulnerability of reversal to reversal by traditional shareholder value-oriented activists. So it removes that threat of intertemporal instability. Now, lots of companies that make climate commitments do quite a lot in terms of trying to show that they're serious about this. And we basically, in the paper, go through various commitment mechanisms that are commonly used, and we basically find that they're lacking. So if you talk about securities regulation, then usually there are two issues. One is that the climate commitment is not generally considered material, And so that's sort of, blunting the instruments of enforcement right there. And then because they're forward-looking statements, as in the Shell case, a safe harbor also protects companies if they decide to change their mind. Reputation, as one of the other speakers today pointed out, is a bit of a complex issue as well, because as long as you basically impose your costs on third parties, then roughly speaking, the reputational mechanism doesn't work so well anymore. And this is exactly what happens in the context of climate change, so difficult to rely on that. And then there's a whole range of other attempts to anchor and create a credible commitment mechanism that are all basically at risk of shareholder reversal. So if indeed a Strive kind of activist investor comes in and wants to get rid of all the climate commitments, then all of these mechanisms are not going to protect the company from that. So these are, let's say, not very credible climate commitment mechanisms that don't get us to the result that we think we should see. But we think we've got something that does, and we call these mechanisms green pills. And the idea of a green pill is actually very simple. It's basically about a company setting a particular climate target, creating a contractual commitment to deliver on that target, and including as an independent promise under that agreement, a commitment to pay a certain amount of money if they don't meet these targets. Now, what does this do? Well, first of all, you do need to have some, clever legal structuring to make this possible, because you cannot have this. You have to basically structure this commitment as an independent promise, but that is possible. And if you do that, then what you can do is you can tailor the degree of commitment with the amount of funds that you're paying out if you're not meeting your climate pledge. Now, this is not an entirely new idea, because in recent years we've started to see something called a sustainability-linked bond. And sustainability-linked bonds are essentially financing instruments where a company takes out a loan and simultaneously set certain climate or other sustainability-related KPIs. And the interest rate that the company is liable to pay under the sustainability-linked bond rises if the climate KPIs are not met. So on the slide I put an example of such a sustainability-linked bond, which was issued by an American company called Energy. And there, the value of the commitment is essentially quite limited. There's only $16.5 million over the lifetime of the bond, but that's basically the amount by which the interest that the company should pay might go up. Now, obviously, that bond is pretty small and the commitment mechanism is pretty minor as a consequence, but the basic idea stands. And we think that if you scale this up sufficiently, then what you can do is you can endogenize the commitment to execute on your climate policy. Because suddenly, if you're a traditional shareholder and you come into this company, you cannot deviate at no cost, at zero cost, from the climate commitment anymore, because you're liable to pay out a certain amount of money if you do. So there's sort of a threshold that you'd have to overcome before you can reverse your strategy in a financially smart way. In addition, if you have a payment like this, if you have a green pill in place like this, then suddenly a lot of the other corporate governance mechanisms become much more powerful. So for example, if you make statements under disclosures that then relate to your climate commitment, it's much more likely that a judge would find them to be material because they're now linked to this larger payout that you might have to make. So that's some of the ex-ante incentive effects that the green pill generates. Now, obviously, if the green pill only has a value of 16.5 million, then that's not really going to move the needle for some of these large companies. So what you have to do is you would have to really scale up the level of commitment right there. Now, if you do that, you get into some issues. You get primarily into the risk that you might see what we call dirty voting, where, for example, an investor buys both the loans and the equity and then strategically defaults on the climate commitment in order to reap a very large payout on the green pill. And if something like that happens, then obviously the mechanism breaks down. So what you can do there is, once the payout becomes large enough, you'd have to make it to a third party. And that third party can be a climate charity, it can be a carbon offset supplier, it can be essentially anyone else, as long as that third party has no governance rights and as long as that third party stakes its reputation on the green pill working as intended. Now, a final point here before I wrap up or this is the wrap-up actually, and this is a corporate law question, is adopting a green pill actually, is it consistent, is it compatible with fiduciary duties under corporate law? Now, this is going to be contentious, right? Because you're potentially giving away quite a lot of money to investors or to a third party, but we actually think this is fine. So basically we think there are no obvious issues of entrenchment or conflicts of interest, which means that judges would likely evaluate this kind of action under the business judgment rule rather than under the enhanced scrutiny or entire fairness standards. And in that case, you'd only need to demonstrate that there is some rational basis for adopting the green pill from a value point of view. And we think that these firm-level justifications exist. You could avoid costly reversals in climate policy, you could capture a greenium from climate-conscious investors, and so on and so forth. So basically, this is all, of course, contingent on how the Delaware judges would look at the reasons for implementing and whether they would second-guess the reasons for implementing a green pill. And so we can't completely promise that it would work, but on balance, we're quite confident that it would. And a particularly nice element of the green pill in that relation is that the extent of the commitment can be calibrated by changing the amount of money that is at stake. So that means that you also have, it's not an absolute commitment, but outside investors and outside observers can at least see the degree to which you as a company are committed to meeting your your commitment to emission reductions. And it is so much better than the whole mess and the uncertainty and the deliberate muddiness of the commitments that we see today. Thank you so much.
So just for folks who I didn't maybe hear the full question, Juan Carlos was asking about the example of Petroperú, which is the state oil company in Peru. And as Juan Carlos noted, it's extremely corrupt, in addition to being involved in imposing oil operations on indigenous communities. And in fact, earlier this week, I was with leaders from communities in Peru, both indigenous leaders from the Amazon as well as from coastal fishing community that have been impacted by pipelines and refinery expansion and oil block explorations led by Petroperú, accompanying them to meet with some of the bankers of Petroperú because they're fighting back against Petroperú's expansion plans. And so, at least as from an advocacy perspective and the kind of work that Amazon Watch does, that's a big part of our work, is making sure that the communities that are directly impacted are getting to be heard by the decision makers who are, lending to Petroperú or underwriting bond issuances or what have you. And we can talk more after as well.
Additional questions?
I have a question.
Sure.
Can I ask one?
Sure.
Okay. This is for Jim. Jim.
Yes.
Sorry.
Right.
You, if I understood you correctly, you essentially said that institutional investors don't have a huge role because in private company sort of pressure because there's no equity to be invested in. But some colleagues, I think, if I'm remembering correctly, of Tom's at Oxford, have looked into the role of institutional investors as the primary purchasers of primary bond issuances. And so, to my mind, that is a place where institutional investors do have a useful role to play. So I'm curious if you guys have looked at that or what you think about it. Yeah.
It's a question of relativity, I guess, because they can act as a private investors in private companies like private equity or venture capitals, but their effect is not as much as in the public companies because there are some other source of institutional investors in public companies. So with the informational basis, they can put more pressure in public companies, but we're not telling that they have zero effect in private companies. But it's not enough. It's not satisfactory for arguing that investor stewardship would be effective in private companies too. So we don't think that it would be effective solution for private companies, investment stewardship.
Okay.
Further questions? Yes, please.
Yeah, I guess this is more a question for Tom. So we now increasingly talk about three types of risks: the physical risk, transition risk, and the mitigation risk. So I think sustainability bonds could work. That's a nice positive enforcement tool. But to what extent mitigation risks are material, and to what extent is it an effective enforcement tool? Have there been any studies? I mean, it's also reputational risk.
Yeah, this is a great question. So in a separate paper, I'm looking at climate.
Is there a mic for the question?
So the question was whether litigation could be another source of creating a credible commitment mechanism, or at least an accountability mechanism. And I was saying that we're looking into the nature of climate-related legal risk right now, because when you read studies on this, it's actually very ill-defined what it means. But to your specific question, so there are some jurisdictions where litigation works really well. So continental European civil law jurisdictions in particular are more likely to hold companies to account for not meeting not only pledges that they have made, but more generally for having a business plan that is not aligned with Paris. And I think, as I said in the presentation, I think the main example here is the judgment against Shell in the Netherlands, which includes not only Scope 1 and Scope 2 emission reduction requirements, but also a best efforts obligation to reduce Scope 3 emissions. Now, as far as I'm aware, this is the only judgment of its kind, and it's on appeal, so I'm not sure if it will hold. In the US, cases of this type seem to be much more difficult. So there was a case where there was a case against Exxon where the court was asked to look into whether it was problematic that the risks that Exxon disclosed around, that essentially Exxon was not acting in line with its climate commitments. And the judge basically said, if I recall correctly, that no reasonable investor would seriously believe that Exxon, would trade on Exxon's shares, believing that they would be serious about their climate plans. And so it cannot reasonably say that these are material, and so there is no damage in that sense. That's a pretty big obstacle to accountability in the US. So I'm not aware of a particular study that looks at this in great detail across jurisdictions, but this is sort of my set of observations on the theme. It's at best it's a big gamble to rely on litigation as an effective accountability mechanism in this context.
Yeah, please.
Again, Tom, I was going to ask, with your green bills and the targets, would it be looking at year-on-year tracking of decarbonisation and whether those were in line with the targets, or would the enforcement only come when the targets were due? And if so, either way, how do you mitigate against the potential financial risks stemming from them? Because if you have year-on-year tracking, there's a sudden deterioration in the macroeconomic conditions, which means companies aren't able to get the funding to deliver on those commitments for a certain year. Could you then have a sort of sector-wide sort of macroeconomic default that would then lead to a lot of payouts? And if it's then alternatively just at the end goal of say 2050, how do you then enforce it sort of prior to that? And at that point, it's almost too late.
Yeah, I mean, this is another great question. So I think what we learned from Kem's paper is that there's always going to be arbitrage around these kind of commitments and around the climate issue in general, and this is no exception. So in the paper, we outlined that we think it's helpful if there are interim milestones, and quite a few, because if you don't, and also in a follow-up paper, we highlight that essentially you should not be able to meet your obligations under a green pill, but also not under, by the way, a court judgment, by just selling your high-emission assets into private markets, essentially the story that Kem is telling. Because if these are ways in which you can meet your obligations, then the whole thing, again, it breaks down. So the interim milestones are really important from this particular perspective, because if you don't have interim milestones, you can just run the company and the assets that it owns, at very high emission levels until the end of the green pill, and then you can default on your green pill both on the environmental commitment and subsequently you don't have money to pay out on the financial commitment under the Green Pill. And then again, the whole mechanism didn't work. So the interim milestones would be an essential part of such planning. Yeah.
Yeah, in the back.
My question is to Tom. So you say that the model that you propose, that there's really no need for us to change the corporate law and we can read into the liability requirement within the contractual terms. We're given a choice between reading in the Paris Agreement as a liability within the law through a statutory legislative process versus keeping the contractual process. Which would you choose and which would you go ahead with?
I mean, if we could have legislation, say carbon tax or carbon pricing through other means, that would of course be ideal. If we could have the legislative framework reflect the commitments that countries have made under the Paris Agreement. But casual empiricism suggests that we're not going to see such a first best response. And so what motivated us to write this paper is to essentially, in light of the fact that we don't see the first best response, think about what we could do essentially without a change through in the legislative system. Now, of course, some people could say, well, we could also change corporate law, but I get always a little bit tired of that debate because that's sort of the general for whose benefit is a company run kind of debate, and then that's a debate that we've been running in circles around this debate for 30, 40, if not more years. And these are always trade-offs and they're never satisfactorily resolved. And so I'm not sure a reform of corporate law itself, as opposed to a broader legislative reform that just addresses the climate issue, that would really be extremely helpful. And so we thought we do not rely on the larger legislative framework changing in line with Paris. We do not want to enter the debate about changing corporate law because we don't really think it's going to go, well, first of all, we don't think it's going to happen, but even if people were seriously attempting it, we are not sure that would actually move the needle. Now, let's instead think about a private solution that in theory companies could implement right now. And then the fact that they don't implement it right now is telling as well. So you create, the idea is essentially let's try and create a bit of a separating equilibrium through that process.
We have time for a couple more questions. Yeah, please.
Thanks so much for your presentations. This question is for Moira and Emil. Could you speak a little bit more about, I appreciate your point about incorporating indigenous rights into standards. Emil, I thought it was very interesting that you said, the reports said 80% agreement, but then on the ground it wasn't. What sort of organizations do you see coming to bear in order to ensure properly that indigenous rights are being respected in the future? Once hopefully these things are incorporated into standards, how will investors know that indigenous rights are being respected? More nonprofits, or are we seeing firms, or what might that look like?
Then go first.
You go first.
Okay. So just a few days ago, the EFRAG published the new set of standards for the European Sustainability Reporting Standards, which actually they took our recommendations line by line and incorporated them. So just a few days ago, some new standards were published for the European Sustainability Reporting Standards, which will be, well, if the EU Commission approves them, they will be incorporated into EU legislation. And so we submitted our comments to their consultation, and they incorporated our recommendations almost line by line. But I think out of 700 responses to the consultation, I doubt any of them talked about indigenous rights. So although they had some language on indigenous rights, it's not something that's being pushed a lot either from the corporate side or from NGOs. If we hadn't submitted that letter, then they wouldn't have included it. And in terms of who will make sure that indigenous rights are respected, obviously the pressure, I think, can come from both from governments, from indigenous peoples, NGOs, and investors. I think it's not a one solution. But I think currently, who addresses indigenous rights violations? That's first of all, indigenous peoples themselves, and then the NGOs to report on it usually. So from the investor side, I mean, they might get some news, but that's usually after the controversy has happened already. So they're not proactively looking into the company claims, oh, they have an FPIC policy, but what does the policy actually say? And they're not really addressing the topic in depth. And I think also because the standards aren't really it's very superficial in the standards that mention it. So if you look at the GRI or SASB, for example, and also the various standards if you look at in the mining sector, so they will say usually their policies say that they will seek community approval or they will consult with communities, but it's not aligned with what actually how human rights courts interpret indigenous rights. So companies will say indigenous rights do not have a veto right, for example. It's true. The human rights instruments do not say that indigenous people have a veto right, because veto is not a human. It's not like a language that exists in human rights instruments. But it's not about the veto right. It's about the right to self-determination of indigenous peoples, the right to exist and determine our own futures. So by saying that indigenous peoples do not have a veto right, then they are basically making the argument that, okay, if indigenous peoples do not give consent to the project, then we can proceed because they don't have veto right. And that's incorrect. If you proceed, then you will violate many of the other rights that indigenous people have, such as self-determination and all other human rights, such as access to water and access to security, health. And if indigenous peoples protest the projects later on, what often happens is government repression, attacks on human rights defenders. So, I mean, if the companies say there's no veto right, it doesn't make it acceptable to take an action that will still cause all those other violations. Yeah, it's like a false argument that many of the corporate standards and policies are pushing, and probably many of the investors that look at the policies, they haven't thought about this topic in depth, so they say, oh, yeah, this is probably what indigenous rights are, but I mean, it's much more in depth. So actually now we're developing an indigenous rights toolkit for investors, which will have really have case studies to show that some investors are addressing those issues, like Trillium Asset Management or Boston Chem Asset Management, for example, and also show some case studies of projects that proceeded without having the consent of the indigenous communities, and which the governments or national or regional courts later determined were illegal. So what happens a lot of times is the governments have regulation or legislation, the state, but then the government also says, but we don't need to consult for this project because of various reasons. 10 years later, the courts at national level or at the regional level or at international level will say, oh, well, this was illegal. So the governments themselves aren't really understanding their own regulations and international regulation either. And I think that's where, that's why I think it's important to have those things in the standards, because then people will be forced to think about it. And I think now that we have pushed for the inclusion of indigenous rights into the European standards, I think thousands of auditors in Europe will start to think about this topic, because they will be required to audit the sustainability reports of the companies. So it's not something that can be ignored anymore.
Yeah, and just to add a real quick point on that, I made a reference in my original presentation about disclosure regimes being necessary but insufficient. But I think part of the reason that they are necessary, particularly in a context like this, is that the information becomes public, right? So if there are requirements that a company is disclosing what communities would be impacted by its operations and whether or not those communities have been consulted with and what's the result of those consultations, the communities themselves, as well as advocates that work with them, can check that and contest it if need be. So it's an important source of information for the communities themselves as well.
Thank you so much. We are at time, but I want to everyone join me in thanking our panelists for a really incredible discussion today. Thank you.